Before the United States had a dollar, it had a mess states printing their own money, rampant inflation, and a currency no one fully trusted. Soldiers were paid in paper that became nearly worthless overnight. So how did a fragile new nation turn chaos into one of the most powerful currencies in history? The answer lies in a series of bold and deeply controversial decisions that didn't just create money. They created a financial system that would define American power for centuries. After independence, the United States faced monetary chaos with competing currencies, debts, and no unified system. In the 1780s, Americans didn't share a single reliable form of money. Instead, they used a confusing mix of foreign coins like Spanish dollars, British pounds, and Dutch guilders, alongside state-issued paper notes that varied wildly in value. During the Revolutionary War, the Continental Congress had printed Continentals to fund the fight, but without strong taxation power, those notes quickly lost value, giving rise to the phrase, "not worth a Continental." Each state also issued its own currency, often overprinting to cover debts, which led to inflation and distrust. Commerce became difficult because a dollar in one state might not be accepted in another, and merchants had to constantly calculate exchange rates. Farmers struggled to pay debts, and creditors demanded hard money, gold or silver, deepening economic tension. This instability wasn't just inconvenient, it threatened the survival of the young nation by undermining trade, taxation, and public confidence. Leaders like George Washington and Alexander Hamilton saw that without a stable, national monetary system, the United States could fracture economically, even after winning political independence. The chaos of this period set the stage for one of the most important financial decisions in American history, creating a unified national currency that people could trust across all states. The Constitution gave Congress the power to coin money and regulate its value, laying the legal foundation for a national currency. When delegates met in 1787, they had just lived through the disorder of state-issued currencies and the collapse of continental paper money, so they were determined to centralize monetary authority. Article 1, Section 8, granted Congress the exclusive power to coin money, regulate its value, and fix standards of weights and measures, while Section 10 explicitly prohibited states from coining money or issuing bills of credit. This was a direct response to the inflation and confusion of the previous decade. By concentrating monetary power at the federal level, the framers aimed to create consistency, stability, and trust, key ingredients for economic growth. The Constitution didn't immediately create a dollar system, but it provided the legal framework that made one possible. It also reflected a broader philosophy, that a strong central government was necessary to manage national finances and maintain credibility at home and abroad. This shift helped the United States begin to build a financial identity that could support trade, repay debts, and attract investment. In essence, the Constitution turned the lessons of monetary chaos into a durable rule. Money would no longer be a patchwork experiment, but a coordinated national system. The Coinage Act of 1792 officially created the US dollar and established a bimetallic system based on gold and silver. Signed into law by President George Washington, this act defined the dollar as the nation's standard unit of money and set up the US Mint in Philadelphia to produce official coins. Influenced heavily by Alexander Hamilton, the first Secretary of the Treasury, the law tied the value of the dollar to specific quantities of precious metals, establishing a fixed ratio between gold and silver. This bimetallic system was designed to provide stability and flexibility, allowing both metals to circulate as legal tender. The Act also standardized denominations like cents, dimes, and eagles, making transactions more predictable and easier across the country. Importantly, the US dollar was modeled in part on the widely trusted Spanish silver dollar, which had already been used in everyday trade, giving the new currency immediate familiarity. By anchoring money to tangible metal, the government aimed to build public confidence and avoid the inflation problems associated with unbacked paper currency. The Coinage Act didn't eliminate all financial challenges, but it marked a turning point. For the first time, the United States had a defined national currency system backed by law, infrastructure, and a clear standard of value. Alexander Hamilton's financial plan strengthened the dollar by tying it to federal credit and consolidating national debt. As the first Treasury Secretary, Hamilton believed that a stable currency depended not just on coins, but on trust in the federal government's ability to manage money and repay its obligations. In 1790, he proposed that the federal government assume the debts of the states from the Revolutionary War and fund them at full value, meaning investors would be paid as promised. This move was controversial, but it unified the states financially and established the United States as a credible borrower. Hamilton also pushed for the creation of the first Bank of the United States in 1791, which acted as a central financial institution, helping manage government funds, issue banknotes, and stabilize the money supply. By linking the dollar to a functioning credit system, Hamilton transformed it from a simple unit of coin into part of a broader financial network. His approach encouraged investment, facilitated commerce, and helped integrate the American economy. Critics feared centralized financial power, but Hamilton's system proved effective in building confidence both domestically and internationally. In practical terms, it meant that the value of the dollar was supported not just by metal, but by the credibility and structure of the federal government itself. Over time, the US dollar evolved from metal-backed coins into a national paper currency supported by federal institutions. In the early years, Americans relied heavily on gold and silver coins, but as the economy expanded, paper money became more practical for large-scale transactions. During the 19th century, banks issued their own notes, leading to another period of inconsistency until the federal government stepped in more forcefully during the Civil War with greenbacks, the first widely circulated national paper currency, not directly backed by gold or silver. Later, the National Banking Acts created a system of nationally chartered banks that issued standardized notes, further unifying the currency. The biggest transformation came in 1913 with the creation of the Federal Reserve, which gave the United States a central banking system to manage the money supply and stabilize the economy. Eventually, in the 20th century, the U.S. moved away from the gold standard entirely, making the dollar a fiat currency backed by government authority rather than physical metal. Despite these changes, the core goal remained the same as in the 1790s, to maintain trust, stability, and a reliable medium of exchange. The modern dollar may look very different from its origins, but it is built on the same foundation established after independence, turning financial chaos into a unified and trusted system.